Hi, welcome back. Today we're going to focus on earnings per share. This is the second lecture of chapter 16. Essentially, earnings per share will indicate the income that is earned for each share of common stock. This is key to note. The shares that you use in your calculation for earnings per share, also known as EPS, is always going to reflect the common shares, not preferred stock shares, but just the common shares. You do use preferred stock in the problem, but you do not use preferred stock shares when calculating the denominator of the formula. We will calculate the simple capital structure basic EPS and then also the EPS for complex capital structures, which is known as dilutive. Under simple capital structures, companies have only common stock or they could have preferred stock, but the preferred stock has to be basic preferred stock. It cannot have any convertible features to it whatsoever. But the key point to note in simple capital structures is that they have no securities that could dilute earnings per share if converted or exercised. So earlier in this chapter, when we discussed convertible debt, equity, options, and stock warrants, those were examples of dilutive securities. Therefore, in a simple capital structure, the company will not have any securities that could dilute those earnings per share. As you see there, the basic formulas for earning per share is net income minus preferred dividends divided by the weighted average number of common shares outstanding. As I note there is a tip that net income available to common shareholders equals the numerator in this problem. Therefore, if you were asked to calculate what is the net income available to common shareholders, it would be the numerator of the formula, or net income minus preferred dividends. So be aware of that for a potential question on a homework quiz or exam. The easiest part of this formula is going to be the net income, as this number will likely often just be given to you as net income. Then you have to account for the preferred dividends. So the key thing to note here is that it is the current year's preferred dividends only. So as we learned in chapter 15, there is different types of preferred stock, as in cumulative preferred stock or non-cumulative preferred stock. For regular preferred stock or non-cumulative, you only deduct them in the numerator part of the calculation if declared. If they are not declared, then you do not deduct them. For cumulative preferred stock, you only deduct the dividend earned during the current year, even if not declared. So even if I have cumulative preferred stock and I haven't been paid in 5 years, the only part that's going to impact this formula is the current year amount that I would be owed. Probably the most complex part of this formula is the weighted average number of shares outstanding during the period. This is something that may be given to you already in the problem, but you may have to calculate it, and we will go through an example of how to calculate this number here in a moment. The key thing to note is that if a stock dividend or split occurs during the year, you treat it as if it occurred at the beginning of the year, and that will make more sense as we go through the example. So let's go through a basic example of calculating the basic EPS in a simple capital structure. A company has 2,000 shares of $50 par value common stock. Also has 10,000 shares of 5% $20 par value cumulative preferred stock, which pays a $1 dividend per share, which is the 5% times 20. And they also have 30,000 shares, of 5% $10 par value non-cumulative preferred stock outstanding during the current year. The net income after taxes was 1.5 million. There were no dividends declared during the current year, and that is key as we start to go through this. So, my recommendation is to break this down into multiple steps. The first step that I would recommend is to figure out what do you have? What are your specific components? Excuse me one second as I get the colors figured out here. I'm going to have to go back here to a different format so this is easier to see. All right. So, our first step, we need to determine each of the components. As I noted earlier, often you'll be given this net income number, so that is an easy number to calculate. We know that net income is $1.5 million. Next, let's figure out the preferred dividends impact in the formula. As we noted previously, there are cumulative and non-cumulative preferred stock. As the fact pattern in the problem provides, there were no dividends declared during the current year. Therefore, the only preferred stock dividends you need to account for are the cumulative preferred stock dividends. Therefore, when you figure out the math, you would come up to that $10,000 is what you paid in preferred stock dividends for cumulative preferred stock. You did not declare this, but since it's cumulative preferred stock, you have to recognize it. With non-cumulative preferred stock, since you did not declare any dividends in the current year, you do not include in the calculation. That is very important to make sure you understand that it's only if it's declared does non-cumulative preferred stock get factored into the calculation. And last, our third component is the weighted average number of common shares outstanding. I have given you this number of 200,000. The next step is to plug this all into the formula. We know that we have $1.5 million in net income after tax. We're going to subtract $10,000 in the cumulative preferred stock shares. And then we're going to divide it by 200,000 shares. So as you can see up above in the formula, it's 1.5 minus the 10,000 divided by the 200,000. And this gives you an earnings per share of $7.45. As you can see, this is very straightforward. I mean, it's pretty clear, pretty basic. If you can keep track of when to account for cumulative and non-cumulative preferred stock, then that is the main kicker to understanding the basic EPS calculation. Next, we're going to go through how to calculate the weighted average number of common shares outstanding if I do not give it to you directly as I did in this example. Please note on your homework or an exam, you will likely see a problem in which you have to calculate the basic earnings per share. But in order to do so, you have to also calculate the weighted average number of shares outstanding. Therefore, I may not necessarily give it to you as I did in this example. So let's move on to that example where you can calculate the weighted average shares outstanding. So as I've given you here, there are 7 transactions that occurred throughout the current year. And then the activity list what they were, and then the total shares to use in column C below in this table. The total shares column there, that is just a running total of the shares outstanding at that point in time. This is an important way to look at it, in my opinion, because it makes it clear how many shares were outstanding at each point in time. Because as I mentioned previously, when a stock dividend occurs or a stock split, you have to treat it as if it incurred from the beginning of the year. So I will give you this type of table on a homework or exam. I may not give you this information, the total shares, but I will at least give you the date and the activity of the information. So let's start with what we know. First, we know the dates. So using this information, we know that from January through April 1st was one time period because January was the beginning of the year, April is when the next transaction happened. then June, then October, November, December, and then December 31st. So as you can see, all this is broken out by the dates, period ranges throughout the year in which we're going to have to calculate certain components to get to the weighted average shares outstanding. Column B, this shows the fraction of the year in which the shares were outstanding. As you can see, 3 months of the year from January, February, and March. 2 months represents April and May, and so on. Column C, the shares outstanding, was taken from this table right here as we ran it up. So we started the year with 100,000 shares. We issued 20,000 shares in April, thus the total was 120,000 at the beginning of April. Then we purchased 12,000 shares of treasury stock. So as we remember, we reacquired it, so that reduces the shares outstanding. Then we had a 20% stock dividend, which gave us 21,600 new shares. Then we sold 9,000 of the treasury stock shares acquired, which leaves us with 138,600 shares. Then we did a 2-for-1 stock split, which doubled the shares to 277,200, and then that was the ending shares outstanding as of December 31st. So this information is essentially what is in this column right here. I will also note that I will give you a table like this to complete on the homework or exam. So I may not give you that, this is B times C necessarily, or like some of that, but I'll give you these headers at least, and so it will help guide you in completing it, because I don't want you to get lost in trying to figure out all these various components as you go along. So to determine D here, so this, we need to determine the fraction of the year that these shares essentially were outstanding. And then this will give us a calculation in terms of when we determine the weighted average of the shares. So for example, from January 1st through April 1st, so January, February, and March, that's 3/12 of the year, we had 100 shares outstanding. So if you take 100 shares outstanding times the fraction of the year that they were outstanding, that is going to give you 25,000 shares. And if you do the same, you can see this is 2/12, so this is 1/6 of 120,000 shares, which, as we remember from above, we issued 20,000 new shares, so we now have 120,000 shares starting April 1st. We get to the component for the weighted average calculation, 20,000, 4/12 or 1/3, 108,000 from this column again, 36, and so on. So this will help us calculate the weighted average number of shares outstanding. And so as you can see, for example, January 1 through April 1, only 25,000 of the shares are represented in the weighted average calculation because they were only outstanding for 1/4 of the year. As I noted, remember previously, that if a stock dividend occurs or a stock split occurs, you have to treat it as if it occurred from the beginning of the year. So in this example, the stock dividend happened in October 1st. So a key thing to note, I would like you to note here, when the stock dividend occurs, the stock dividend is represented in these shares already. So as you can see, this 129,600 as of October 1st, that includes the 21,600 new shares. So since it happened at this date, this period, October 1st through November 1st, November 1st through December 1st, and then December 1st through December 31st, the stock dividend is already reflected in this balance. Therefore, you do not need to do anything else, as it has already been accounted for in those periods. However, you need to make sure you note, since you have to reflect this as if it occurred at the beginning of the year, these 3 periods, the January through April, April through June, and June through October, those periods did not have the stock dividend impacted in the calculation. Therefore, you need to go back and calculate it as part of those periods. And this is simply done by simply doing this is that you will take the 25,000 times the 1.2, 20,000 times 1.2, 36,000 times 1.2, and that gets you what the stock dividend would be for those periods if it occurred at the beginning of the year. Now in column F here for stock splits, it's the same way. You have to treat it as if it occurred at the beginning of the year. As you will note, the stock split occurred December 1st. Therefore, December 1st through December 31st, this is when the stock split occurs. But you need to go back as if it occurred at the beginning of the year. Therefore, in this example, every period needs to reflect this 2-for-1 split. So, to get to the weighted average shares outstanding for each period, you will take this fraction of the year shares outstanding, the 25,000, you will times it by the 1.2 stock dividend pact. This gives you 30,000 shares at this point. So 25,000 times 1.2 is 30,000 shares. And then a 2-for-1 stock split means you will take that 30,000 shares and you will times it by 2, and that will give you 60,000 shares. So you will do the same thing all the way down. And as you can see, for example, I would like to note that there is an error in this table. As I was trying to figure out why the last 3 columns here, the numbers did not add up, it is because these 3 numbers are incorrect. As this says here, B times C is what it goes in this column. So, I apologize for this error. So, to get to this number, it is going to be 1 divided by 12 times 129,600. This gives you 10,800 shares. Therefore, when you take 10,800 times 2 for the stock split, it gives you 21,600. And I will do this again for the remaining 2 here. You will get 11,550, and then times 2 gives you 23,100. This gives you 23,100 times nothing, because the stock dividend is already reflected in this balance, so therefore you have nothing here for the stock split to occur. I apologize for those errors in the table, and hopefully this makes sense now in terms of the calculations. So before we get to the end game here with the weighted average number of shares, which is 262,200, which is going to be the 60,000 plus the 48,000 plus your 86,400 plus 21,600 plus 23,100 and plus another 23,100, and that gives you 262,200. So if you use this number, this would be what you put in the denominator part of the EPS calculation. I hope that this makes sense. And this table will help you understand the concepts of what is going on here. I would like to note, just to remind you, that stock dividends and stock splits need to be reflected as if they occurred at the beginning of the year. In this example, we only had to adjust for the stock dividends for the time period January 1 through October 1 because the stock dividends already reflected in October 1 through December 31st, for example, as we talked about in this table. So do not multiply 1.2 here because these are already reflected. The stock dividend is reflected in this number, the 129, therefore it carries through to the remaining ones. So you have to go back to the beginning and adjust for the ones that do not have the stock dividend reflected. The stock split is the same way. You would have to go back to beginning. Since the stock split occurred at the beginning here, December 31, there is no impact to go back because this is the period in which the stock split occurred. In the handout, we treated the EPS calculation and the calculation of the weighted shares separately. However, you may be required to complete both of these within one problem. So for example, I may give you the same similar type of information, but I may not give you the company at 200 shares outstanding. I may make you calculate that number and then combine these two processes to calculate the earnings per share. So you will make sure you want to be able to do this. You'll definitely make sure you want to be able to calculate the basic EPS given the example we went through, and also be able to calculate the weighted average number of shares. I will tell you right now, you will be required to do this on an exam. This table to calculate these shares for the basic EPS calculation. So if you have any questions on this, please let me know. Specifically, remember the hard part of this is remembering the stock dividend and the stock split impact on the weighted average shares outstanding calculation. Hopefully this table will guide you and make sense, and this is how I will structure it on the exam so you have plenty of space to fill it in and walk through the steps to make sure you don't miss anything along the way. All right, moving on. Now we are going to talk about complex capital structures. Whereas we just got done talking about simple capital structures in which the company did not have any dilutive securities like the ones we talked about earlier in this lecture for convertible securities, options, and warrants. A complex capital structure is one in which those securities are present and they could dilute the EPS formula upon conversion. It does not mean they will make that number smaller, but it could. The key thing to note difference between basic and dilutive here. You will always report the basic. However, a company will not report the dilutive EPS if the securities in their capital structure are anti-dilutive, and therefore increase the earnings per share. So as an example of this, say the basic earnings per share calculation, similar to what we did above, was $7.45 per share. Say we did a similar problem like that and the dilutive EPS came out to be $10 per share. You would not report that $10 per share in your financial statements because it was not dilutive of your earnings per share because your basic number was lower. So therefore you will only report the dilutive earning per share when it is lower than the basic earnings per share. So as you can see there, it requires the presentation of both basic and dilutive. And then the dilutive EPS measures the effects of potential conversion on the earnings per share. So a company has these convertible securities, so you need to account for what would happen if those things did convert and how would that impact your earnings per share. The main thing here to take away from the formula, it is the same formula, but you have to adjust it for all the convertible and dilutive securities, and this will impact both your numerator and your denominator. We will walk through how convertible bonds impact it and how convertible preferred stock impacts it. So as you can see, it's the same formula. For convertible bonds, you need to treat this as under the if converted method. Therefore, you need to assume that this conversion has occurred, and that is occurred as the beginning of the year, or at the issuance if occurred during the year. This has two impacts on the formula. It will increase the weighted average number of shares outstanding, because you are going to be converting from bonds to common shares, similar to what we went through previously in this chapter. And then you will increase your numerator because you are going to eliminate the interest expense you incurred, and then you will make that net of tax. And we will walk through this to make sure it makes sense. So as an example, assume the after-tax net income is $500,000. There are convertible bonds with interest expense of $50,000, the weighted average common stock outstanding of 50,000 shares. The company had preferred stock dividends declared of $10,000, and the tax rate was 30%. The convertible bonds were convertible into 2,000 shares of common stock. So, similar to what we did previously, you need to calculate the basic earnings per share. So, we know the net income is 500,000. We know the declared dividends were 10,000, and we know the weighted average common shares outstanding were 50,000. Therefore, our basic earnings per share is $9.80. And there's a tip there that if the diluted EPS calculation is greater, then you will not report it in the financials. You will only report the basic earnings per share, because it is not actually dilutive to your EPS, these securities. So similar to above, we're going to break this into steps. So your first step, you want to calculate the components of the EPS calculation. Remember, you must assume the conversion has occurred. So we know in our numerator, the first step is net income after tax. That is 500,000. As we noted here, you will eliminate the related interest expense. This is a numerator impact. That is the next step component here. We need to eliminate the interest expense. This is going to increase your numerator by the net amount of the taxes. So you will take the $50,000 you paid in interest expense, and you will multiply that by 70%, which gives you 35,000. This 70% represents the fact that you paid 30% of the tax already. So you need to get back the amount, the additional amount of tax. Next, you need to reflect the preferred stock dividends declared, because that's part of the numerator calculation. And that was 10,000 as given in the problem. Now you need to calculate what the increase was to the weighted average number of shares. This was given to you by the fact that the convertible bonds were converted into 2,000 shares of common stock. Therefore, you treat this as if it occurred at the beginning of the year, so these 2,000 shares will be added to the 50,000 weighted average common shares outstanding. The next step, we will plug these numbers in to calculate the dilutive EPS. So this is where the calculation really differs from basic EPS. So we have the 500,000 in net income after tax. We need to add back the interest expense we paid net of tax because of the conversion, because once they convert from the debt to the equity, so the bond to the common stock, you are no longer paying that interest expense. So you have to reflect it by adding back the interest net of tax, which is the $35,000. Then you need to subtract the 10,000 Similar to the formula above, the net income minus preferred dividends. Then you're going to divide that by the weighted average shares outstanding plus the new shares that were reflected because of the convertible debt becoming common stock of $2,000. This will give you an earnings per share of $10.10. Your third step in the process is now comparing the two. Your basic earnings per share was $9.80. Your complex or dilutive earnings per share was $10.10. Therefore, you cannot report the dilutive earnings per share because it is actually anti-dilutive, because these conversion features actually increase your earnings per share. So before we move on to convertible preferred stock, just to make sure you take away the key points here, is that you need to remember that you treat as if it happens for convertible bonds. There are two impacts for convertible bonds on the dilutive EPS calculation. There's the impact to the weighted average numbers of shares outstanding, which is the denominator, that will increase. Then you will also need to eliminate the related interest expense net of tax. That is the numerator impact, and that is because you are converting from bonds which you were paying interest or were receiving interest, and the fact that they are now transferring to the common shares outstanding. In both circumstances, the elimination of the interest expense and the addition of the weighted average number of shares, it will increase both components of the calculation. Both the numerator will go up by the net of or the elimination of the interest expense, which was the $35,000 in this example, and then the denominator will go up by the increase to the weighted average number of shares. So in this example, you will only report the basic EPS because it is less than the dilutive. Now we're going to talk about convertible preferred stock. So similar to convertible debt, there are impacts to the calculation for this. There are two impacts. There is one, you need to eliminate the preferred dividend from the numerator. And two, you need to increase the weighted average number of shares outstanding in the denominator. This is because under convertible preferred stock, you assume that the conversion happens. And when the conversion happens, the preferred stock dividends will no longer be there because you converted the preferred stock into shares of common stock. Therefore, you have to reflect that you won't receive those dividends from the numerator and increase your shares in the denominator because now the preferred stock has become common stock. And as the formula dictates, the weighted average number of shares outstanding is only related to common shares in the denominator. So in this example, assume the similar information. After-tax net income of $500,000, cumulative preferred stock of $25,000, cumulative convertible preferred stock dividends of $25,000, regular preferred stock dividends of $10,000, which were declared during the year, the weighted average common stock outstanding of 50,000 shares, and a tax rate of 30%. The convertible preferred stock was converted into 5,000 shares of common stock. So your first step is calculate the basic earnings per share. As the formula indicates, it is net income minus your preferred dividends. So the cumulative preferred dividends were 25,000. You would subtract those regardless if they were declared. But the regular preferred stock dividends were declared during the current year, thus you get to remove the 10,000 as well. You will then divide that by the weighted average shares outstanding of 50,000 shares. This then gives you a $9.30 basic EPS. And as it says, this reflects the fact that you remove all the preferred stock dividends. Okay. For the diluted EPS calculation, key note here is remember that the if converted method is applied. So the $25,000 in dividends were converted into new shares because the cumulative preferred stock was convertible. So you assume that that conversion happens where that preferred stock has now transferred to common stock. Therefore, you do not have those dividends to be reflected in the numerator. And we will walk through this. So let's break down what we know. So we know that net income is 500,000, that the dividends left now is 10,000, and that is because we no longer have these cumulative convertible because they were converted into common stock, and we use the if converted method. So what if it happens? The share impact is 5,000 new shares, and this is from the conversion of the convertible preferred stock being transferred into 5,000 shares of common stock. Therefore, as you can see, you removed the dividends from the numerator of the calculation because you're not reflecting the 25,000 anymore, and then you increase the denominator by the 5,000 new shares from the conversion of the convertible preferred stock to common stock. Therefore, when we plug this into our calculation, we have the 500,000 net income minus the 10,000 in dividends. Remember, we do not subtract the 25,000 in the dilutive EPS calculation because we assume that the conversion has occurred. We assume that the conversion has occurred and the preferred stock is gone and no longer there, so it transfers into new shares. Therefore, we increase the denominator by the 5,000 new shares, and that gives us an earnings per share of $8.91. We compare this to the basic earnings per share, and therefore it is dilutive because the complex dilutive EPS is less than the basic EPS. Therefore, you report both numbers in your financial statement. So the convertible preferred stock in this example was dilutive to the earnings per share because it decreased the earnings per share. This instructor note is just to tell you to use the most advantageous conversion rate available to the holders of security. I will not try to throw anything confusing, but if you were to see this in practice, if the conversion rate differed throughout the year, like the first part of the year it was convert to 5,000 shares, and then the second part of the year it was 10,000 shares, you would always do the one that's most advantageous, so the 10,000 shares in that example. Two other things for dilutive securities that would impact the earnings per share. You're only going to be able to know the conceptual components of this, but I will not require you to actually be able to put this into the calculation and calculate earnings per share. But just to highlight that if the exercise price, so the price to acquire the common stock, which is talking about the treasury stock method here, is less than the market price of the stock, you have dilution occurs. Therefore, you're decreasing your earnings per share. If the exercise price is greater than the market price of the stock, the securities are anti-dilutive and not accounted for in the dilutive EPS. So just make sure you understand A, B, and C there from a conceptual standpoint. You'll not be able to take that and apply numbers and do the calculation. The last part of this lecture is this table, and this table just provides you kind of a recap of how each of these impacts the numerator and the denominator of the diluted EPS calculation. So this is very important to understand, especially these two. This will make sure you understand in each circumstance when the numerator goes up or down or the denominator changes and how they change. So if you refer to this table as you're completing the examples, then I think that it makes sense as you go through the calculation on what goes impacts the numerator, what impacts the denominator, and how it is impacted. So that is all for today, but before we end here, I'd like to just recap and let's go back through this really quickly just to kind of highlight some of the key points here. For earnings per share in a simple capital structure, so the basic form, you will not reflect any dilutive security, so convertible debt or equity. This is just going to be the most straightforward example that you would use. Remember that you only deduct regular preferred stock dividends if declared, but cumulative preferred stock dividends always subtracted unless it is converted, and then in that place when we get to dilutive EPS, then that impacts there. Remember that if a stock split or dividend occurs, you need to reflect it as if it occurred at the beginning of the year when doing the weighted average number of shares outstanding during the period. When calculating the weighted average number of shares, make sure that you are taking into account the stock dividend and the stock splits. Use this type of table to your advantage, as I will even put these headers in there for you. So this will kind of help you as you're going through the analysis. The key thing that can mess this up for you, one is if you don't account for this correctly, the stock dividend and stock splits, as if it occurred at the beginning of the year. But two is not getting the shares outstanding right at each period. And that is why we have this calculation here. So just to go through this again, this is the beginning number, 100,000. We added 20,000 shares. We reacquired 12, so that takes us down to 108. We had 21,600 new shares for the stock dividend, so that increased. We sold 9,000 of the treasury stock shares, thus we get 9,000 back to the outstanding. We did the 2-for-1 split, so doubled, and then we ended with 277,200. Remember, be aware that you will likely have to do both the examples that we just went through for basic EPS in one problem. Under complex capital structures and dilutive EPS, remember that you present both basic and dilutive EPS unless the dilutive EPS is anti-dilutive, which means that it is greater than the basic EPS. The same formula is used for basic and dilutive EPS, except the dilutive EPS is adjusted for the impact of all convertible and dilutive securities. Use the if converted method. This essentially means assume that it happens at the beginning of the year. Assume that it occurred regardless of what the fact pattern says if it did or did not. Make sure you understand how the conversion for convertible bonds impacts the numerator and the denominator of the EPS calculation. And make sure you remember that you can only report dilutive EPS if it is less than the basic EPS. For convertible preferred stock, make sure you also understand how it impacts the numerator and the denominator. Remember that it follows the if converted method as well. And in that example went through, you could report both basic and dilutive EPS because the dilutive EPS was less than the basic EPS, which represents the fact that the convertible securities actually diluted your earnings per share or decreased your earnings per share. And then lastly, make sure you understand this table, as this will definitely help you from a conceptual standpoint as well as a computational standpoint on how to calculate both basic EPS and the dilutive EPS calculation. That is all for chapter 16. Hopefully all of this information helps and makes sense as you go through your homework and your quiz. I will say that if you are struggling to understand how the EPS calculation works and how you calculate the weighted average number of common shares, I would refer to the textbook, as it does have a few more examples on the calculation. But remember, you will only be required to understand what's in this lecture handout, but for reference purposes, it would not hurt to look at some additional examples included in the textbook. All right, if you have any questions over chapter 16, please let me know. Your chapter 16 and your chapter, or your chapter 16 quiz and your chapter 16 homework will be due March 21st by 11:59 p.m. and this is the Monday after your spring break. So please be aware that you do have 20 days, essentially 3 weeks, to complete the chapter 16 material. I will also encourage you, do not wait until the day that the homework and quiz are due. The homework will take some time, so please prepare accordingly. Also, Chapter 17 homework and quiz will be due by March 28th by 11:59 p.m. I will tell you now, for planning purposes, Chapter 17 is much shorter and in much less detail than Chapter 16. Therefore, you can plan your schedule out over the next month accordingly. What we will do, we will have the test on the 29th. I will release the materials Tuesday, March 1st at midnight, so you will have them ready to go first thing Tuesday morning if you wish to get started on the course. We'll have all the way until Wednesday, April 6th, is when your next exam will be. I do have the material for exam 2, or the location and the time, and I will send that out in an email and post it to Desire to Learn. That is just a recap of where the schedule is at now. That is all. So please let me know if you have any questions, and make sure you are checking your emails, as I will often reach out to each one of you to inquire about how the material is going and see if you have any questions to help. I will also plan on providing some additional problems and a review document similar to what I did for the first exam, and I will post that in the coming weeks closer to the the second exam date. Have a good day. Bye.